Hello, Mr. Garg. Welcome back to my channel. I hope you're doing well and you had a good break.
Thank you so much, Parul, for having me again. Yes, I'm doing very well. This was a relaxing break, a festive weekend over the last week. So, really had a break of sorts that way.
Great. So, Mr. Garg, the topic that we have today to discuss is around income tax filing, which is obviously one of the hot topics amongst the NRIs, which is non-resident of Indians. So, I'll start by asking the first question that how does one's residential status affect their taxability of global income in India?
Well, an excellent question to begin with. If I were to say in India, the taxability of an individual's global income is significantly influenced by their residential status. If we were to go by the Income Tax Act 1961, it clearly outlines the criteria for determining whether an individual is a resident Indian, a non-resident Indian, or a resident but not ordinary resident, RNOR. So this is a status which was brought in recently only. So this is another thing which is to be noted very carefully. So if your status is resident, it's essential to note that all your global income becomes taxable in India. This means that any income earned anywhere in the world is subject to taxation in India. Conversely, for NRIs who are citizens of India but working overseas, only the income earned or accrued in India is taxable in India. So that is how the residential status affects the taxability of the global income in India.
Right. And I think for the viewers, if you don't understand what an NRI status is, if you don't understand what a foreign income is, please check the webinar 1, which I'm linking in the description box below. You can go and check. I think that will give you a lot more context. And of course, if then you come to see this question, it will make a lot more sense. But I understood that. So just a follow-up question I have on that is that we did cover the residential status topic in detail in the earlier podcast, session 1, like I said, but I would also like you to, for the benefit of our viewers, just state briefly the criteria to determine the residency status of an individual. Just like a brief, and I know we covered previously, but as a brief recap.
Certainly. So an individual will be deemed to be an Indian resident if he or she fulfills any of the two criteria in any of the previous year. By previous year, we had already mentioned that it starts from 1st April and ends on 31st March. So the condition 1, the criteria 1 is if they are residing in India for a tenure of 182 or more days during the previous year, or criteria 2, if they stay in India for 60 days or more during the previous year and 365 days or more during the 4 years immediately preceding the previous financial year. So if you do not meet any of the above conditions, then you are an NRI. If you meet either one of those conditions, then you are a resident.
Right. Got it. And then I think you also mentioned 3 things in the initial part. You said resident, non-resident, but then you also said non-ordinarily resident, which is RNOR. So what do we mean by resident but not ordinarily resident, which is RNOR?
He has to be classified as a resident but not ordinarily resident, RNOR, for a particular year. Then he has to fulfill the following conditions, any of the following conditions. First, he's been a non-resident for the 9 out of 10 previous financial year preceding the year under consideration, or if that condition is not applicable to him, then staying in India for 729 days or less during the 7 previous years preceding the year under consideration. If either any of these 2 conditions are met, then he will be a resident but not ordinary resident. Now, this is an interesting thing which was brought in by the Finance Act 2020. So this amendments was made to the residency provisions extending RNOR status to Indian citizens, persons of Indian origin visiting India. Apart from these 2 conditions, there are a couple of one. He has an income in India which is more than 15 lakhs. This is excluding his foreign income. It's only the income which he's earning in India. If it's more than 15 lakhs, or he has stayed in India for 120 days, but less than 182 days in a previous year. So there are cases where NRIs come, they stay back in India for a period of, let's say, 121 days or 122 days. Not in a cumulative way, but they can be broken up. They come in April, they left in May, then they came back somewhere in October, November, and then that's how they covered a 121 days period. But still, their days were lesser than 182 days. In those scenarios, then it becomes essential to establish whether he is in RNOR or a resident or a non-resident. So that's how 120 days was brought into picture. Then if these criteria are met, then that individual will be recognized as or classified as an RNOR.
Right. And what was the purpose of bringing in this amendment?
So this deemed residency status, which was incorporated in Finance Act 2020, concept was introduced for Indian citizens earning excess of 15 lakh rupees from sources within India. That they were earning more than that, and then they were being classified as NRIs. They were not liable to tax. So they wanted to increase the jurisdiction of taxation in that sense. So the categorization of deemed residents as resident but not ordinarily resident is effective from financial year 2021. This change carries implications such as the loss of double taxation avoidance agreement DTAS benefits and increased scope of total income for taxability and the forfeiture of various exemptions which are available earlier to NRIs. So that is the reason why they brought in the RNOR. Earlier it was very simple. You are there for 182 days or no, or you are there for 60 days or 365 days, the earlier criteria which we had recognized. If not, then you are a NRI. But now with this RNOR, this has brought in many complications, and NRI has to be on top of it. And that's why it's very essential, as you had mentioned in the earlier podcast, that you need to get in touch with a taxation expert or tax professional who can guide you on these areas.
Right. So we understood the residency status. Let's just move ahead and understand the sources of income for an NRI that are liable to be taxed in India. So what are some of these sources of income that typically NRIs would be getting in India, which is taxable in India?
Surely. We'll discuss this in detail, point by point. Let's start by listing a few incomes that are considered as income earned or income accrued in India. The first one, salary received in India for services provided in India. So even if you're categorized as an NRI, income from services rendered in India, regardless of where you receive the payment, will be subject to taxation in India. So that's the first one. So it does not matter whether you're residing in Australia, you're providing the services in India, but even if your salary is credited to your Australian bank account, it will still be taxable in India because that services were provided in India. Okay. The second one, income from a house property situated in India. So the rental income. So income calculations aligns with the resident norms. NRIs, whether renting or leaving the property vacant, can claim a 30% standard deduction, offset property taxes, utilize interest deductions on some loans. They are also eligible for ATC deductions on principal repayment, along with claiming stamp duty or registration charges under the same section. But their income would be taxable in India. These deductions are definitely available to them, but their income is also liable to be taxed in India. That is for the second income. Third income, the capital gains, which is the major concern of many NRIs. The capital gains arising on transfer of assets situated in India. Now, the assets could be your securities, your mutual funds, equity shares, your property sale. So any capital gain from transfer of such assets are liable to be taxed in India. Okay. Then the fourth category would be income from fixed deposits or interest on saving banks account or NRO accounts. Those earnings from fixed deposit savings account, they have to be taxed in India. They're subject to be taxed in India, though there are deductions available against them, certainly as with the normal resident are, but then they have to be taxed there. But point to note is that any FD made out of NRE account or FCNR accounts, they are exempt from tax. So, and only the interest income earned on the NRO accounts, that is fully taxable.
Yeah.
Okay. So this is the fourth one. The fifth one, that's again the major one, is the income from business or profession. So in case NRI is running business operations in India or providing any professional services in India, so any income generated from such activities is liable to be taxed in India. But it is immaterial whether that income so generated is received in an offshore bank account. The income was from the services rendered in India, so that has to be taxed in India. So this is the case with all of them. So even in case somebody says that I have a property in India, that tenant is limiting that rental amount into my foreign bank account or to my NRO account, it's still liable to be taxed.
Right. And I believe so, for example, typically for resident Indians, there is a long list of deductions and benefits that you can claim, like ATC, ATCC, then there is ATD, ATE, like a lot of deductions that you can claim. So you mentioned about the different sources of income. Are the same deductions and benefits which is available to, let's say, the resident, it's also available to non-resident, or there are some distinctions between these two categories, like something is available only for resident versus non-resident and vice versa?
All right. So Parul, as you mentioned, there are plethora of those deductions available. But there are certain ones which are available to both residents and non-residents, but there are certain exclusions also. But let me start off with what are the deductions which are available to NRIs. Okay, so if we were to start off with the first one, you mentioned ATC. Yes, ATC is NRIs are eligible for deductions under ATC. So ATC would include life insurance premium payments, children's tuition fees for 2 children studying in India, principal repayments of home loan, ULIP contributions, investments in ELSS schemes, equity-linked saving schemes. Those are the mutual funds which come out with a lock-in of 5 years or 3 years one. So those are available to under ATC to NRIs. Then the other deductions which are available to NRIs, deductions from housing loan interest portion. As I mentioned, any income earned from house property, all the expenses which a resident Indian can claim. So all those expenses are available to NRIs also. Deductions under Section 80D for health insurance premiums available to them. Then under Section 80E for the interest paid on education loan. So in case any education loan was taken and now that person is working overseas, so he's repaying that interest, that education loan, and he's making some interest repayments of principal repayments. So that deductions are available to him. Then for any donations made for social causes, and I like to make some contributions to charitable causes, so that deduction under Section 80G is available to them. Then, as I mentioned, for interest on savings bank account or NRE accounts, so deduction under Section 80 TTA up to 10,000 rupees is also available to NRIs.
Right.
So many a times what happens is that NRO accounts, they fetch in interest income of, let's say, 12,000 rupees. Now they would bank would certainly pay off that 12,000 rupees, and they would deduct a TDS, that 30% TDS. Now actually only 2,000 was taxable, rest 10,000 was exempt to them. So in that 3,600 rupees which got deducted as a TDS, that can be claimed as a refund up to the amount of interest which is exempt, which is 10,000 rupees. So in a nutshell, you would end up paying only 600 rupees. 3,000 could have been claimed back by you as a refund.
Right. I think you mentioned about health insurance. I remember because I was planning to, I just took a health insurance, by the way, a few months ago. So when I took that, so I came to know that the GST on that, if you are an NRI, you can actually claim that GST back, provided you have made the payment from your NRE account and you can provide that receipt. So I think that's obviously an added benefit that let's assume if you have taken a health insurance, let's say you've put 10,000 rupees and you have put in some GST, then you can claim that GST, which
So
of course,
that's
if
a
you don't have an
very good.
NRE account, yeah,
Yeah, that's a very good point that you brought in. So that GST is about 18% here in India. It's not
right,
only applicable only on health insurance, it's applicable on life insurance as well. So you can
right.
claim back any GST paid on your life insurance premium as a refund. So you will have to write into them. It's not that they will not charge you at the initial stage. They will charge you, but they will refund that amount to you.
But do we need an NRE account? Payment has to be done in an NRE account, not
Yes.
from an NRO account.
No, not from NRO account. It has to be done
Right,
from NRE account because you are residing abroad. You buy. There are cases when what happens is that, as you had mentioned in your previous podcast, that many people continue to operate their savings account in India when they change their status into an NRI, or
right,
when they are returning back to India, they continue with their NRO accounts even though their status has changed to resident India.
right.
For that, to be sure, the insurance company to show that your status is still an NRI, they have made it compulsory that payment has to go through NRE account.
Yeah, I remember that because that was the criteria. So I think I just wanted to add that that's also an added benefit that you can
Definitely.
claim that GST back, depending on, yeah, health insurance, life insurance, or whatever. Cool. And what are the things that are not available? Like these are the things that you mentioned are available, but there must be things that are not available
Yes.
for NRIs.
There are few specific deductions that are not allowed to NRIs.
Okay.
So if I were to name that, let's take Section 80C only first. So NRIs cannot open new PPF accounts. They can
Right.
invest into PPF accounts, the earlier PPF accounts, up to the limit of 15 years, but they will not be able to open new PPF accounts. So they can maintain those existing PPF accounts while they were residents. Other investments which are not allowed under Section 80C would be NSE saving schemes, the post office 5-year deposit scheme, or the senior citizen saving schemes. These are the 3 or 4 schemes which they are not allowed to invest into. Then benefits under Section 80DD and 80DDB. That this deduction is provided for maintenance, including medical treatment of a handicapped dependent or a dependent who is disabled. Now, this deduction is also not available to NRIs. Under Section 80U, a deduction is provided to a taxpayer if the taxpayer himself or herself has a disability. Now, that same deduction is not applicable to NRIs. So these are the few which are not available to NRIs.
So
The
you
few major
mentioned
ones.
the scheme that you mentioned, NES, right?
NSC, the National Savings
NSC.
Certificate. National
Oh,
Savings Certificates.
National Savings Certificate. And there was another one which you said?
Post Office 5-year deposit scheme and Senior Citizen Savings Scheme.
Right. And I think in the last podcast, you also mentioned that for senior citizens, I think the amount, I think it was at
The
par with the
slab,
resident.
yes. So the exemption, the exempted income is up to 2.5 lakh for normal citizens. Senior citizens, it's 3 lakh rupees. But now those 3 lakh slab is not available to NRI senior citizens. They will their income, if their income exceeds 2.5 lakhs, they will be taxed accordingly.
Right.
The slab is start from there.
Understood. Good. So we spoke about residency status, then we looked at the different income which is taxable, and obviously we also now spoke about the benefits and deductions. Another key thing which a lot of NRIs face is this whole thing around the double taxation or the dual taxation. And I know India has double taxation agreement with most countries, I believe Australia, US, like correct me if I'm wrong, but I believe with most countries. So how can NRIs tackle or navigate this double taxation situation, and what does it mean for them?
Okay. Now the specter of dual taxation is very daunting for most of the NRIs, and for rightful reasons. But there are provisions in place to help NRIs and from being taxed in both India and their resident home country now. So DTAs, the double taxation avoidance agreements, are the bilateral agreements which has been entered between India and the subsequent country to reduce the possibility of double taxation. They provide these DTAs are a document which provide clarity on for which country has the primary right to tax specific sources of income. So most DTAs will have it enshrined in them that the right to tax any income generally lies with the country where the income is getting generated. It's not that income got generated in India, but it will be taxed in Australia, or it will be taxed in UK for that matter. If it has been taxed in India, whatever criteria they had, they must be having certain criteria for determining that income level and getting it taxed. It will be taxed out there. Though what could happen is that let's say India had for capital gains. Let's take it for the capital gains piece. Capital gains was taxed at 20% in India. Now you had a capital gain of 1 crore rupees in India from sale of property. Now 20% tax rate would have entailed a 20 lakh rupees of tax foregone in India. You come down to UK. Now UK has a taxation rate of 30%. So what will happen? They will consider that 1 crore rupees was okay. You had paid as 1 crore rupees was your capital gain out there. 20 lakh rupees you have already paid. You pay the remaining 10 lakh rupees as a tax out there in the UK. You can take a tax credit. So that's a provision. Yes.
Yeah.
So there's a provision of claiming tax credits. So NRIs can very well explore the provisions of tax credit in their resident country for taxes paid in India. Many countries provide a mechanism for taxpayers to claim this credit for foreign taxes paid. This ensures that the same income is not taxed, and it provides a kind of a relief to the taxpayer.
So does it also apply for somebody, let's say, who has a foreign income? They can also claim that tax offset back in India, right?
Yes, in case his or her global income is getting taxed in India.
Exactly. So let's assume if he or she is a resident Indian, they just came for, let's say, 2 months assignment or 3 months assignment or whatever, let's say to UK or the US. Like a lot of IT people do that. So they are still resident of India because they don't meet that criteria requirement. But of course, their global income would be taxed back in India, but they can
claim a tax credit.
Correct.
Yes. So this happens, Parul, with cases where employees receive ESOPs, the employee stock option scheme, and those companies are globally listed. The stocks are listed in the NASDAQ or somewhere in foreign exchanges. So it's available to them also that the tax was deducted out there. Now, when they're filing income tax returns in India, so they will be filing that they had received this ESOPs as an income, as an additional source of income. This tax was deducted, and now they can claim a credit.
Right. But what happens, I'm like a bit curious to know, what happens in case of, let's say, Dubai or UAE, which is not taxable? Like what happens in these countries?
In these countries, basically their income is not taxable at all, right? So that comes into play. It becomes very essential for those category of residents, whether or those NRIs, whether they are residents in India or not. In case they become a resident of India by any chance, then whatever income they have earned in Dubai, whether it was taxable or not taxable, it will become liable to tax in India. The global income becomes taxable in India. So that
But
global
if they're
income,
an NRI,
if they're an NRI, then their global income is not taxable in India. Then only the income generated in India would be taxable. So it's very essential.
If they have made a capital gains back in India, and of course it's not tax. I mean, so they don't have to claim for any offset, right? Because they don't have to pay anything on their foreign income, which in this case is an Indian income.
They won't have to pay any tax out there in Dubai, if that's what you were trying to ask me.
Exactly.
So then in Dubai, they would not be taxed because their Dubai income is not taxable. Their foreign income is also not taxable in Dubai. But in India, if they become residents, then they are in
Right.
for trouble. Then whatever they have earned out there, that will become taxable in India, irrespective whether they have paid tax or not.
Yes. That's why a lot of people are fleeing to Dubai. But
It becomes
I think
more of a tax haven kind of a way, but it's a more efficient
yeah,
way. There are not no free lunches at all anywhere in across the world. So Dubai, it appears that they are non-taxing country. They do not charge you any tax, but their tax appears in various forms in a hidden manner.
right. No, absolutely. I think you're right. And I remember, Mr. Garg, that I think it was in July sometime this year that there were some taxation changes in the budget. I know the capital gain taxes were changed from 10% long term to 12.5, and I believe there were some changes in real estate as well. And there were a lot of hue and cry, and then there was an additional line item which got added around the inflation proof. So maybe do you mind just telling our viewers the top 2 or 3 changes that were introduced in the budget?
Sure. Let's start with the first major change that was brought in. So the first major change was the way we determine the holding period for capital gains. So if you are investing in securities or other assets, this is definitely will want to pay some attention to the NRIs viewers. So what's changed? The intent is to simplify the things by having only 2 holding periods to determine whether your capital gains are classified as short term or long term. So those 2 holding periods are 12 months or 24 months. So let's break it down. For listed securities like shares or units of listed business trust or mutual funds, the holding period is now set to be 12 months. Okay, so this means if you hold these assets for more than a year, you will be looking at long-term capital gains tax rates. For all other assets apart from these two, the holding period is now 24 months. This includes bonds, debentures, golds, unlisted shares, or immovable property. So good news here is the holding period for assets like bond, debentures, or gold, which was earlier 3 years or 36 months, has now become 24 months. That's a significant cut. So you invest in gold, keep a physical gold, or you invest in gold ETFs, debentures, your holding period gets reduced to 24 months. Okay, but what does it do to your tax rates? So if we were to talk about the tax rates for short-term capital gain has been increased from 15% to 20% for equity shares or equity-oriented mutual funds. It was earlier 15%, now it has gone up to 20%. And if we were to talk about the other asset classes, short-term capital gain rate has been kept unchanged. It will be taxed at the applicable tax slab rates. So if you fall in 10%, 15%, 20%, whatever tax bracket you fall into, you will be taxed accordingly. You choose a new tax regime, old tax regime, that will be charged accordingly. Now, if we were to look at the long-term capital tax rates, which you were just mentioned, now those have increased from 10% to 12.5%. So there's an increase of 2.5%, which has gone by. But then again, the asset classes which were being taxed at 20%, and there was a indexation benefit being allowed out there. I'm talking about property, gold, bonds, debentures. On these asset classes, you could avail an indexation benefit and then being taxed at 20%. Now that indexation benefit has gone away, and they have made life simpler in terms of charging you a flat rate of 12.5% by deducting your cost of acquisition from the sale value. Whatever gain you arrive. Now, the thing for NRIs to note out here is because there was a lot of hue and cry with indexation going away. So what was done was that if there's an asset, property, gold, or whatever we are talking about, on which indexation was available, if that was purchased before 1st April 2001, the NRIs are still eligible to go with indexation and 20% tax rate. Because let's say you purchased a property way back in 1990 for a 1 lakh rupees of 100 square yard plot or a 200 square yard plot. Now, what you will have to do for that one is that you will have to first arrive at a fair value dated 1st April 2001. And from there, you compute your indexed cost for the current financial year in the year of sale, and then apply 20%. If you foresee that is beneficial to you, go with that 20%. If you foresee no, even after having computed that indexed cost, after having that fair value arrived at 2001 and having that indexed cost and 20% is still more, and it's advisable or it's beneficial for you to go with 12.5%, you can choose that. So that option is left with you. But for resident Indians, they still can avail indexation benefit for any property or any asset acquired up till 23rd July 2024.
Oh, so I thought that change that you can choose between indexation or paying that 20%, or was it 12.5%?
20%.
20%. I thought that is also eligible for NRIs. You're saying that choosing between the two is only for resident Indians.
It's available for NRIs only for property or asset purchased before 1st April 2001.
Right. Yeah. I thought that it's also for 23rd up to 23rd July. No, that's not the case.
No, that's not the case. That was a fine line which they brought in the fine print when the finance bill was approved. Many have missed up that part.
Right. So basically what you are saying is that for NRIs, if they have purchased a property before 23rd of July 2024, it doesn't matter that date. For them, the cutoff is April 2001. Sorry.
2001.
April 2001. They can choose between getting the indexation benefit or that 20%. But
indexation benefit and 20% or 12.5%.
Or 12%. So indexation benefit and 20% or 12.5%. But for resident Indians, they have given that benefit that for them the cutoff is July 2024.
Right.
So in case they have purchased any property before that, obviously the same two choices are given to them.
Yeah.
Oh, so I think they've kind of penalized NRIs, it seems like.
I don't know what was the intent behind that, which I don't understand as of now. But there certainly would be something which the government would have thought.
Right. So how does it impact the NRIs in that case, who is, let's say, of course, that cutoff is no longer, the case. So who is selling the property or let's say gold or anything, like you said, bonds or debentures, which was initially 20%. How does it impact them?
So basically, Parul, this is a very big topic in itself. We will have to have a podcast around this thing because this has a fair share of the nuances. But as I said, there's this 12.5% is a choice which they can avail, whether they without indexation. What does it entail? Let's take it. Let's understand by the help of an example. If somebody is selling gold for a matter for once, gold they are selling, they've got an antique gold, they got it through inheritance. They're selling that gold for 1.5 crore rupees. Now that or they purchased that gold way back in 2005, and that time the gold value was around 6,000 rupees. Now it's trending at 85,000 rupees. So 84, or let's take it at 85, and 6,000 was the purchase price per 10 grams. So if they minus that, they arrive at 79,000 per 10 grams. So that 79,000 rupees per 10 grams is taxable at 12.5%, fair and square. But if they had that gold acquired through an inheritance, and that we don't know the year of purchase even, so we will take value as of 1st April 2001, which is listed in the Income Tax Act. That's somewhere around 4,500 rupees. And we will inflate that value to present value. So that will bring us closer to, let's say, about 18,000 rupees. Now you can, or 20,000, let's take it to close it at 20,000. Now deduct 20,000 from that 85,000 rupees, you're left with 65,000 rupees. So apply 20% on that. that will give you a tax of almost 13,000 rupees. So earlier was about 10,000 rupees. Now it's 13,000 rupees. So with the indexation also, they did not have that much of a benefit. But this might not be the case with property. Property would have a something, some fair value which would have been determined by a registered value. So in that sense, what fits for one does not fit for the other. So one size does not fit for all. So as I said, we'll have to do a podcast on this one topic.
This is one of the coming episodes where we'll talk in detail about real estate and everything. But I feel like on the surface, at least, it looks like that NRIs have been not getting benefited from this particular change as much as the resident Indians, because they still have that choice. But I think for NRIs, they don't have.
Yeah.
Unless, of course, if they have purchased a property before 2001. But if they have purchased any time in last 24 years, then obviously that's going to be different. Perfect. I think we have come to the end of this podcast. Thank you so much, Mr. Garg. And I think it's been an extremely useful session. We'll continue to have these chats. Thank you so much.
Thank you, Parul. Thank you so much.
FMR Finance Weekly. Simplify your life with our financial advice.